Welcome back to another episode of That Backyard Property Podcast. We're back for another mini-series. So today is an exciting one because we're going to look at how you can use your existing property to purchase another one. And whether that be an investment or whether that be another owner-occupied property to upgrade to, or whether you're taking cash out from your property to buy a car, to buy shares, to renovate, to do a new kitchen, to do a new bathroom. So this all falls under the same roof of using equity. It's a jargon word, but that's what it is. So what I want to do today is to look at the actual numbers to guide you through how to look at it for yourself as an individual or as a couple so that you can work out what you have available in your property to be used towards something you're looking to do. And in some cases, you don't want to do anything at all. It's just nice to know that your property is increased in value and you've paid down some of that debt, because we all want to get rid of that home loan debt because it's a burden. So let's tackle it today. For an example, I'll use myself. So if I've got a property that's worth $1 million, what the banks want to do is they want to make sure that you're borrowing less than 80% of that value so that they don't charge mortgage insurance. The interest rate is less. And in most cases, to get that equity or cash from your property or value from the property, they generally only want you to use up to 80% of the value anyway. So in this instance, I've got $1 million property, which would be nice, and I'm going to times that $1 million by 80%. So take out the calculator, whatever the value of your property is, times it by 80%. That will give you the 80% mark. What we're going to do next is then subtract your existing loan balance from that 80% number. So in my example, $1 million property times it by 80%, we have $800,000. The current debt is $600,000. So we're subtracting $600,000 from that $800,000, which gives us $200,000. There's a lot of numbers in that. So take your time with it. So what we're doing is working out that 80% number, and we're subtracting our existing loan balance from that to give us the available equity or available cash that we can use. We can use that available cash in whatever way we want. I'd strongly encourage it not to be used for jet skis, holidays, credit card debt, or whatever it might be, but it can be used because it's obviously your money or your equity. So in that instance where I've got $200,000, what can I do with that? As I said, we could use that to buy another property. We could use it to buy shares. We could go ahead and renovate our kitchen or renovate the property. We could consolidate other debts. We could go and buy a car or whatever it might be. So using that $200,000, what I would want to look at in this example is buying another property. And let's look at buying an investment property. So if I was wanting to buy an investment property, let's say it's for $500,000. $500,000 purchase over here and my property over here. That $500,000 property generally needs a 20% deposit, so $100,000, plus about $25,000 to $30,000 in costs like stamp duty and legal fees. So over here we have our $200,000, and we need about $130,000 as a deposit over here for this purchase. So we can literally take this money from the bank as cash to be used as a deposit for this investment property. And it sounds simple, and it actually is when you get the process right. What if I haven't found the investment property yet? Is really, really common question. And that doesn't matter because it's okay. You don't need to go ahead and buy this straight away. And the way that works is really simple. That $200,000 can come out as cash, as I mentioned. So what the structure could look like is your existing loan amount of $600,000, and then a second loan of $200,000. Now, the really, really important point in this aspect is the product that you choose for that $200,000 investment loan. The product in this case I would prefer is an interest-only product. This is obviously general in nature, but I would prefer it to be interest-only. The main reason being is that I would then not pay any interest or repayments on that debt until I've used it. So in this instance, we have our new $200,000 loan. That $200,000 can sit in an offset account against the $200,000. Because the offset balances out the loan, there's no repayments. And because it's interest only, there's obviously no interest, but there's no principal to be paid, so there's no repayments. This allows us to then have access to that $200,000 at any point in time that we find the investment property, because it's then accessible, because it's literally sitting in your offset account. As soon as you draw down on that money, so in this instance, I draw down on that $130,000, I will then start paying interest on that portion. Double check this with your accountant. In this instance, if I was using that $130,000 of the equity to buy the investment property, then that $130,000 would generally be tax deductible. So all of a sudden, you've got your deposit, you're ready to buy the investment property, and you've allowed some tax deductible debt that's attached to your home. We can go into debt recycling in another mini episode, but in this instance, it's just the ability to use this money that's over here, this value, because equity is value in your property. So in that instance, we've used our 130 and now we've bought this investment property. One of the most important parts of doing this is that your home, so in this instance, my home sits over here, it's completely different and separated from the investment property, which means we can use a completely different bank, which is such a benefit when it comes to selling either of the two, refinancing either of the two, or trying to do the same thing again with either of the two properties, because they're with a different bank and they're not linked in any way possible. So if you're going through this process with either a bank, which I wouldn't recommend, or using a broker, which I would recommend, make sure you talk to them about whether the properties are separate, because the last thing you want to do is cross the two properties over. The best analogy that I've got in this instance is when you're looking at your TV and the cords behind the TV are all tangled, that's when your properties are tangled. TV still works, but it's a mess behind the TV. Alternatively, in this instance, you've kept them separate, TV's working, the cords are separate, easy to unplug one or the other whenever you want. If this is something you're looking at doing, get a valuation, get an understanding for what the value is in your property, multiply that value by 80%, and then subtract your existing loan amount from that, and that's the value you've got in your property to be able to do anything with it. In a lot of cases, it's to buy another property. Because one of the things I hear a lot is, how did that person get that second or third property? And that's the way to structure, especially when you're using an interest-only product on the investment cash-out loan. Because the objective should be to pay down your owner-occupied or home loan that's not tax deductible before your tax-deductible debt, which is used for investment purposes. It's obviously general in nature, and I'd strongly encourage you to talk to your accountant about the best way to structure this. But if you're at home, it's really easy to do a DIY. Do DIY, understand the equity that's available to be able to use it for whatever purposes you want. If you need any help at all or have any questions, then reach out. And one other thing, if you could like or subscribe in whatever medium you're watching this, Spotify, YouTube, Apple, whatever it might be, please do so, because it really helps us, and then we can obviously help you. Thank you, and I can't wait to see you again next week.